FX Nation, what's up guys? Welcome back to the channel. Welcome back to another video. And as we continue the Blueprint Summit, in this video we're going to go ahead and break down for you the type 1 patterns. We're going to get into as many details about the pattern as possible. So without further ado, let's go.
So what does a type 1 pattern look like? So the first thing is I want you guys to visualize this line here. This line represents the 5 p.m. reset that we talked about. Okay? That's what this line represents, this red line. And then we draw out our Asian session, right? This Asian session is basically the time that we have from, let's say, 5 p.m. Eastern Standard Time through about, let's say, 2 a.m. Eastern Standard Time, right? So if you remember back to that graph that I showed you about the session times, this is basically Sydney, the Australian, the New Zealand, and the JPY, right? So you basically have price that's going back and forth, 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 back and forth. Okay? This, throughout this time here of 5 p.m. to 2 a.m. is when market makers like to make the initial low of the day and the initial high of the day. So what does a type 1 pattern look like? Type 1 patterns does this. If it's creating, let's say, a W, it'll do this. It'll come down past the Asian low and it'll make the W and come back up. So this would be a type 1 setup. Your Asian range, price action moves aggressively past the low of the range in this case, and then creates the W and then comes back up. The trade that we're trading is basically this move back up. Now let's talk about what does that same type 1 look like if it's a sell, right? So same thing. We're going to extend that line out so you can see what happens. But basically it does this instead. It goes up and then it basically makes the M and then comes back down. It breaks the Asian high, makes the M, and then comes back down. This right here is the trade. We have to wait for this to happen. If you're trading a type 1 setup, you have to wait for this to happen. You have to be patient for the M to develop and to show. The easiest way to identify a type 1 pattern is literally when price breaks above or breaks below the Asian range. That's it. If it breaks below or above the Asian range, the only option that you have to trade is the type 1. That's it. The only other thing that happens, we'll get into type 4s, is when it does this and then it does that. A strong move past that breaks the Asian high or the Asian low. So now, when we're creating the M's and W's for a type 1 setup, like I was saying in the description of it, is that they have to form during the London or the New York box. So what are the London and New York boxes? So the box is basically set from 3 a.m. Eastern Standard Time to a max of 7 a.m. So that's the timing of the box, is 3 to 7. The best setups are produced between this time. And ideally, if you want to make it even smaller, ideally the best possible setups are between 3 and more about like 5:45 or so. But there will be times where it extends out to 6:30, 7 a.m. the max. By 7 a.m., there's nothing to be traded during a London session. So if you're trading a London session, okay, and you've identified that because of your schedule, your work, whatever, you're going to be trading a London session, you're basically going to be up at 3 a.m. to 7 a.m. is the max that you'll be up. So basically a 4-hour window. Now, because every day is different, you might get a setup at 3:30 in the morning, right? This here might set up at 3:30 in the morning some days. Some days it may set up at 4:30 in the morning, right? There's no specific time that these set up at the same time over and over and over again. We found that the range is about 4 hours. So everything that I'm talking about now with these setups are using a 15-minute chart. So type 1s, 2s, 3s, and 4s, all 15-minute time frames. Now with the type 1 setups, an important factor to understand is that there could be different variations of the type 1 setup. So here's what I mean. So let's just pretend that this box here represents the London session, right? The 3 to 7. And then let's say that this box represents the US session time frame. The US session time frame that we're looking at is 8 a.m. through about maximum 12 p.m. So same thing, 4 hours. So 4 hours in the London session and 4 hours in the US session. That's it. Any other time outside of this does not matter at all. The only other time that would matter would be 2 p.m. US session. That's when the FOMC news gets released. And that's when you would definitely see some huge movements during that time period, right? But for the majority of the time, we're not trading news. News is going to be crazy volatile. You're going to have to use some crazy stop losses. It's just not worth the squeeze. You can double your account or you can blow your account during news. So remember that what we're trying to do is we're trying to be consistent over an extended period of time. Because we're not here to trade for just 1 week. We're not here to trade for a month. We're not here to trade for a year, right? We're trying to literally continually trade over years. So to be consistent over years, you have to understand that there's going to be certain times in the market where the liquidity, the volume, the movement are just too wild. Spreads are crazy, and it just doesn't make sense for you to trade throughout those times. Understand that when news gets released, and we're talking about specifically the big news that makes market move, 30, 40, 50 pips. Whenever that news happens, those events are used by market makers, by banks, to complete patterns. So you'll still see the pattern. The only difference is that you'll see the type 1 pattern like this, but at this time frame here, you'll see a candle that is like this. You'll see a body, and then you'll see a huge wick like that, huge wick like that. How many times have you seen a candle like that during NFP? During the high volatility times of news, that's what you'll get. Because all that is done during the news on a candle like this is trapping traders going short, trapping traders going long. That's it. The real move most of the time happens after this. Right? So you will see candles, of course, that are that end up being, like this, for example. Right? Huge freaking candles like that. Unless you're anticipating something like that happen, how could you possibly get into that? These candles are like 50, 60 pips. So the times that we're looking at trading is we're not looking to trade primarily during the news. There are certain news events that will trigger that kind of behavior, and there's other news events that won't do anything at all. Literally won't do anything. So with the type 1 pattern, the different variations, if we have the London box and the New York box here, right? there's a pattern that you could have that's basically this, like that. You would have this. You would have that. And then you would have this, right? So that's like your typical type 1 pattern where you have both legs in the London session. Going to be another pattern, a type 1 pattern, that would produce something like this. And so the second leg actually ends up being in the New York session, and the first leg is in the London session. So this would be considered like a multi-session M. And the last one would be is if you were to see something like this. So you have a strong move that happens during the London session, and then they literally just move sideways, 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 sideways. They get to the US session, they tag, they go up, tag, and then they drop. Same thing as a multi-session M, but you just don't have the big drop in apex that you would typically have. So what this looks like on a chart is literally just candles back and forth, you know, like this. Just straight candles back and forth, back and forth, back and forth. Trading in a range like this. That's all it is. But the main ones that you're going to see is this, where both legs happen in London, or where you have a multi-session setup and the first leg is in London, second leg is in New York. So very similar, same thing, works the opposite way. Is if you are in, if it's creating a W, let's say, and you have same thing, a London box and a New York box, and it's making a W this time, same thing, you would have a W here. If you don't get a W there, you would basically get this same thing. Okay, and the same thing applies. The trade is this. We don't trade this. We don't trade this. We wait for the second leg. Are there going to be times when this happens like this? Absolutely. This is going to happen. But that's not what we're trading. Because what we found is if you start trading this right here, this just V shape, your winning percentages actually go down by 30%, because not all of these actually end up working out. So again, why take the risk? It just doesn't make sense for us to take the risk. So I don't know about you, but I don't want my odds to be 30% less because I want to trade a specific V shape or whatnot. So you have to wait for a second leg. You get paid to wait. Literally, you get paid to wait. To trade Forex, you're literally getting paid to wait for the right setup. That's why when you come up to a trading day to trade, you may not always find a trade setup for that day. And again, that's perfectly fine. There's nothing wrong with not trading that day. Would you rather trade every day and have a losing day rather than not trade that day because there was no actual good trades and not have any losses? The only reason that you're wanting to trade every single day is because you still have the regular job mentality of, hey, I'm in front of the charts here for X amount of time, and guess what? I want to get paid for that time, right? Because whenever I go to work and I clock in for 4 hours, I get paid for 4 hours, no matter whether I do something or not, right? The company still pays you. Here, in this environment, you need to understand that sometimes you may wait for a setup that may not appear, or the right setup that may not come for that day. But I can promise you, if you don't trade that day and you hold off, and the next day you come in and the right trade setup comes in, that setup that you waited for to show up on the next day will pay you for both days. So very important to understand that we're not here to trade every day. If you're doing it right, okay, if you're doing it right, you should be able to get 3 to 4 trades a week on a consistent basis. And these 3 or 4 trades are the creme de la creme trade setups. So 3 to 4 trade setups a week is what you should average. And that's, let's say, on if you're looking at maybe 4 to 5 pairs.
All right, guys, so hopefully you got some value from this particular video. Again, man, we're going to keep breaking down these videos every single time. We're going to give you as many details as possible. So there is no excuse about what a pattern is and what the strategy that we are trading is. So I hope you got some value from this video. If you can please leave me a comment below. Let me know what you think about the series so far, and also like and subscribe to the channel, guys. Thank you so much. We'll see you in the next one.